Good morning, everybody. To those in the room, my apologies that I'm not there with you. To everyone online, thank you for joining us. Can I have the next slide, please? After some fairly heavy tax detail and then the restructuring alarm bells, you'll be delighted to know that the audit update is actually quite straightforward this morning. There aren't huge swathes of new standards to be considered under either IFRS or UK GAAP, or certainly not that impact the hospitality sector significantly, which is good news. Anyone applying international financial reporting standards will be aware that they are now UK standards as opposed to previously EU adopted ones, or a hybrid if you're a December year in. So that is one change, but it is minor. So on the one hand, accounting standard wise, that is a positive piece, but inevitably anything that I give with one hand, I take with the other. And so I just wanted to do a brief update on the audit market. The audit market, like so many, is going through something of a challenge with people, resource, and in essence, there are simply not enough accountants in the UK to deliver the work that is required. And part of that is because of regulatory change, which we'll come on to. What does that do? Inevitably, it leads to increasing costs. And so really just to everybody, just to kind of set out what is happening. What we're seeing at the moment is significant increases in audit fees across the FTSE market, which is where the fees tend to start, so where the regulatory pressure becomes most acute. Between 2019 and 2020, the average fee increase was 27%. Between 2020 and 21, it was 28%. And across the AIM 100, so the largest AIM companies, those numbers were 33% and then 30%. So significant compound increases over the years. That is now effectively passing down to private and private equity-backed businesses. So I guess just a word of caution that when considering inflation, definitely professional service fees and professional service fee inflation is very significant at the moment and running way ahead of headline inflation rates. There are also a number of auditing standards which are changing, specifically ISO 315, which considers risks and risk application. That is likely to mean audits take longer, which firstly makes it more expensive, but also means if a timetable is critical to you, then that planning work should be taking place as soon as possible ahead of year end. And it would be well worth working through with your auditors what plans are in place to make sure timetables can still be delivered despite these changes. So that is an audit market position. I'm sure your auditors will be talking to you about the impact, but just as a fair warning on the changes that are in place. The second point is disclosure requirements and updates. So this is front end specifically, although it does touch on some back end disclosures. There is increasing pressure and expectation, and indeed you only seem to need to pick up the business pages to see auditors being voted against by corporate shareholders because they haven't made a company disclose certain information. Obviously, it isn't the auditor's responsibility to consider those front-end disclosures. However, that seems to be where the pressure is going. So I will fairly pass that on to directors and companies and say, look, there is increasing focus on disclosure requirements. The key areas here are a lot around sustainability. We've got the carbon emissions piece. We've now got TCFD. So that is broader climate change disclosures. That hits the listed market first and the large privates. But inevitably, the direction of travel is increased disclosure around planning for climate change policies, and particularly with net zero plans. And just allied to that, things like the Section 172 statement, so looking at stakeholders and what you're saying about how results are and the decisions that you're making, how they're impacting stakeholders. Again, if you're going to make statements around your carbon plans or around green initiatives, well, how does that impact the business now and what does it look like going forward? So there's a lot of pressure on just ensuring front-end disclosures are more robust and more robustly evidenced. The other piece around this which has just come out, the number of things coming out of the Financial Reporting Council at the moment is quite staggering. But one of their latest updates is on discount rate reporting, which can impact a number of people in our sector, either because you're applying IFRS with a lease, and so you're looking at incremental borrowing rates, or because you're doing impairment calculations, or because you have a property at valuation. In each case, where assessments being made, judgments being made around discount rates, there is new guidance on the quality of disclosures that should be given and sensitivities, not only what the rate is, but how it's being derived. So in theory, relatively easily fixed, but it needs a bit of planning and a bit of thinking through what you're actually wanting to say and how much information you have to be able to say it. So that's just one that's out there, and I think is going to become more important over the coming months with consumer pressure, potentially economic uncertainty. We might well see those sensitivities becoming more critical in terms of disclosure requirements. Finally, no presentation on audit update can be complete without mentioning the fact that we finally have a government response to their consultation, which has been a long time running, the Restoring Trust in Audit and Corporate Governance. You no doubt will have heard about this. The Queen's speech did end up including something of a version of this. It isn't a promise of legislation, it's a promise of a draft bill, so something to at least be considered within this Parliament. That likely pushes timings out to 2024, but what does this really mean? Well, again, a shake-up within audit and within responsibilities for directors in terms of corporate governance. So there'll be a mixture there of disclosure, of additional statements that need to be made, policies for audit and assurance and governance, and the audit impact, again, a drive for competition, a change in terms of shared audits, which again will impact costs, I'm afraid to say. So a whole raft of things that are coming through. This in particular is focused at larger businesses. So there is a view to capture PIEs, public interest entities, and large privates, about 600 in the UK, it's thought, may be captured by the idea of having revenue over 750 million and employees over 750. The biggest thing that has been caught in the draft document so far is that the current way of assessing size of companies or groups is by company individually. So if you operated a group worldwide, but with employees in lots of different companies, you wouldn't necessarily get caught by some of the restrictions that are in place at the moment for employee numbers. However, the draft legislation, the draft response, or the response to the consultation, clearly says that there is a view to capture group numbers, not individual company numbers. So what we've seen at the moment is the thought around what the bill will look like for the largest entities, the public interest entities. What we don't know exactly yet is how that will impact the other entities of public interest, where a lot of hospitality companies could be caught. So where you have global employee numbers, at the moment that's set at 2,000 for an other entity of public interest. If that definition goes from company to group for the largest, it may well go there for smaller entities, and therefore we could find very significant increased requirements for those running groups. So something to bear in mind. If this impacts you, or you have an interest in this, we have a webinar tomorrow, 8:30 to 9:30. Delighted to welcome Sir John Thompson, the CEO of the Financial Reporting Council, along with our own head of audit, Scott Knight, and our senior partner, Matthew White, who will be discussing what this might mean and the timetables and how it will impact entities and audit firms.